Welcome to Life Planning 101, brought to you by Smart Money Group and Kennedy Financial Services in Eastland, Texas. Tune in every week as we share important information to help you and your family live life on purpose. Insurance, investments, legacy and tax planning, and much more. All covered now on Life Planning 101.
Here we are with another episode of Black and White Market Minute on Life Planning 101. Matt Ervin, Aaron Kennedy with you today, and special guest Ryan Holcombe. Ryan, thanks for being with us today. He's going to join in here in just a second and give us a little bit of insight on some real estate. But right now, Aaron, tell us a little bit about what's going on. We got earnings, noise, market volatility, a little bit of everything.
Yeah, it's actually been a great year so far. The market's up quite a bit. Actually, the fourth quarter was very positive too, so there's a big change in everybody's portfolio values from, let's say, October until today. We got a little bit of breathing room. It feels really good. Lots of noise going on. I think we had close to 1,000 companies come out with their earnings reports this week. This week, right? Super busy. We had a lot of economic numbers. And looking at the economic numbers, everything is pretty dang hot. Yep. Nothing's slowing down quite as much as the Fed wants. Our unemployment actually got better. The things that we are producing is heating up. So our economy is being really resilient. GDP came out at a really good number at 2.9%. But, if we strip out what the government spent, the difference in our trade values, we had about 0.2% growth if we're looking at it through the consumer lens. So 0.2, it's not as good as we really want. It feels like we're doing a lot of catch up because, earlier the inflation, everything that was going was because of our supply problems, and we're catching up with that. But now we got to deal with what the Fed's been doing, which is raising interest rates. So we should start to feel that pressure through our economy. So everybody hold on. We're going to be a little bit volatile as we're working through all this noise. We're in great shape. But I really want to hear what the economy likes through a different lens. So I got Ryan here, and we were talking earlier, and we want to see what Hines is thinking, how they're looking at real estate, interest rates, because if you're looking through the real estate lens, this is where it really all comes together, and it's not a clear picture, but you can see how one thing affects the other.
You bet.
So, Ryan, what are y'all thinking, Ryan?
Morning, everyone. Hines as a whole believes that we need to wait to put any dollars to work until we see interest rates stop increasing. It's hard to go purchase an asset where you have negative leverage, which means that it's going to cost you more money than you're going to make on the asset, which we're in that territory now. Last building we purchased was back in August. We paid all cash for several assets towards the end of the summer. But moving forward, we're sitting on billions of dollars in cash because we know there's going to be an opportunity come forward with this cycle, and we want to take advantage of it. The portfolio we have is never been more stronger. It's almost fully occupied. We're collecting rent from every person. We've got several great new alpha creations that are happening in the portfolio, but what we can't control are valuations. The only real estates that are trading hands right now are funds that are needing to liquidate for just liquidity purposes, and so they're having to take whatever they can get on the market. So when you're doing a comparable to your asset, you'll only compare what's been traded, and the only things being traded are for a discount. We're not looking to pay for anything right now or buy anything, so we're not going to buy anything at today's prices, so we're waiting for discounts, and nobody else is wanting to sell today unless they get a top dollar, so there's not really anything happening in the marketplace. So you're going to see a potential decrease in valuations across all sectors of real estate for the next several quarters. But if you're a firm like Hines who's sitting on good cash flow, the distribution yields are staying the same. So it's kind of like that analogy of having the milk cow, and prices of beef are down, but prices of milk are up. So your milk is continuously paying you a good income stream. It's like, do you go sell the beef cow right now and get a decrease in value, or do you keep that cow still making that income and still making that milk at today's prices? And that's what having real estate in your portfolio is going to do. And if you own real estate now, you made money last year, and you're going to continue to.
Yeah,
I love that.
Yeah, I do too. I like that. And we're obviously country folks. So I had a client the other day compliment on the performance of Hines, and there's several clients that have it. And I kind of have a question around. I know you guys do global exposure, and you are several different asset classes of real estate, right? What are you seeing as far as, or have you seen any kind of sector-specific trends? Like when you look at, single-family housing versus office space versus commercial, are you seeing anything react faster or slower in those different sectors of real estate?
Office still has a negative connotation due to COVID and work from home, even though Class A, best-in-class office is actually outperforming a lot of the sectors. Retail has come back a lot faster than anybody expected. Now, the mall that you used to go to is still going to be a drag on retail, but grocery anchor tenant retail centers are doing really well because they're still producing a good income stream. Mm-hmm. And warehouses or industrial are still going to be good because people are still shopping at Amazon, and we're still having stuff being shipped to us, so you need a place to put it. So then what leaves is residential. I think the firms that went out and bought a bunch of single-family housing, they were banking on rental growth, and I don't think you're going to get that. That's why Hines never went to residential single family, because we didn't think there was going to be a big growth. But multifamily, think about it. If you can't afford 7% on your first home, you're going to go stay at an apartment complex for a couple more years.
Yep.
So that's why we want to have
Absolutely.
that.
Yeah, that's interesting, and I appreciate you diving through that. And we're getting kind of close on time. Aaron, is there anything you want to chime in about real estate or the questions or any other feedback?
We've looked at Hines or our real estate position the same as we do everything else. Mm-hmm. We've started off with a pretty small position, and we're actually hoping that real estate comes down, because very easily we could double everybody's real estate position and be okay in our portfolios. And that's what we want to do, but we're not going to do them at these prices. Mm-hmm. So if it comes down, we're going to be licking our chops to add some more, and that's really what we want. And if it doesn't happen, like Ryan said, we're getting a great income. We got a great stabilization piece in our portfolio, but I'm ready to go shopping. I'm ready to pick something up on sale.
Well, it always helps to have dry powder, and it sounds like it's not only in our portfolios but across other firms as well. Like Hines are being stewards of their capital. That's something we're huge on, and so when minds align, great things can happen. So we're really excited. And Ryan, thank you so much for being with us today. Really appreciate your feedback. Thank you, Aaron, as always. Thank you so much. Appreciate everybody here. And this wraps up our podcast today on Black and White Market Minute on Life Planning 101.
Thank you for joining us for Life Planning 101, brought to you by Smart Money Group and Kennedy Financial Services. If you have questions, you can email them to lifeplanning@kennedy-financial.com. Be sure to tune in next week for more Life Planning 101. The opinions expressed herein are those of the firm and are subject to change without notice. The opinions referenced are as of the date of publication and are subject to change due to changes in the market or economic conditions and may not necessarily come to pass. Any opinions, projections, or forward-looking statements expressed herein are solely those of the author, may differ from the views or opinions expressed by other areas of the firm, and are only for general informational purposes as of the date indicated. Securities offered through Calton & Associates Incorporated, a registered investment advisor, member FINRA SIPC. Investment advisory services offered through Smart Money Group LLC. Kennedy Financial Services and Smart Money Group LLC are separate entities and are not owned or controlled by Calton & Associates Incorporated.